Welcome, deep divers, to the deep dive. If you were tracking the markets on August 5, 2025, well, you likely felt that tension in the air, didn't you?
Oh, absolutely. Palpable is the right word.
Yeah, it was a day that really felt like a tug of war. This
Mm.
constant push and pull between some pretty bearish economic signals and uh, those persistent hopes for some kind of bullish turn.
Mm-hmm.
We saw the S&P 500 after opening with some early gains just reverse course quite dramatically, closed broadly lower.
Yeah, near the lows of the day, actually.
It was a stark reminder, really, of just how volatile and, well, uncertain things feel right now. Demands a sharper understanding of what's really driving these shifts.
Couldn't agree more.
So today our mission is to try and cut through some of that noise. We're taking a deep dive into the global markets analysis, economic crossroads, and policy pivots report, specifically the one from August 2025.
A very detailed report, as always.
Exactly. And our aim really is to extract the most important nuggets, the key insights from this dense report, and help you understand the core drivers, maybe some hidden currents, and the surprising turns behind these recent market moves.
Get beyond the headlines.
That's the goal. Arm you with a more informed perspective.
Okay, so looking at this report, what really jumps out, I think, is this critical shift in market psychology we've seen.
Mm.
For a long time, maybe too long, the market operated under this bad news is good news idea.
Right. The old paradigm, weak data means the Fed cuts rates.
Precisely. Weak economic data was almost welcomed because it implied central bank stimulus, specifically interest rate cuts, were coming.
Yeah.
Think about Monday's session, just the day before. We saw this really powerful rally driven by a weak jobs report, exactly because investors expected the Fed to step in.
Makes sense.
But then, Tuesday, the market reacts negatively to further economic softness, and that suggests we've reached a genuine tipping point.
The tipping point. How so?
Well, it feels like a moment where the fear of a real economic slowdown and what that does to corporate profits might finally be overriding the optimism for those rate cuts. It's a significant change in interpretation.
That is a crucial observation. And in this deep dive, we're going to unpack all of that. We'll get into the specific data that really spooked the services sector. I mean, that's a huge part of the U.S. economy.
Absolutely massive.
We'll explore the surprising resilience of what people are now calling the AI economy versus the struggles of the real economy. That divergence seems to be getting starker.
It really does. A key theme.
And, of course, we'll connect all these market shifts to the Fed's growing dilemma and this complex, often kind of fraught web of global trade and geopolitical tensions swirling around.
That's to cover.
Definitely. Okay, let's dig in. So let's start right at the source, with the immediate catalyst for Tuesday's market downturn here in the U.S.
Right.
After what looked like a promising start, building on Monday's strength, major U.S. indices just flipped, turned negative mid-morning, closed near their lows.
Yeah, it wasn't gradual. It was quite distinct.
And this wasn't just random noise or profit-taking, was it? The report makes it really clear this was a direct reaction to macro news.
Absolutely. It overshadowed earnings, shifted the focus squarely onto the health of the domestic economy, and the primary cause, the July ISM Services PMI report.
Okay, the big one.
Yeah, and this isn't just another number. It's a huge bellwether. The report registered near stagnant, 50.1.
50.1. And the consensus was what, 51.5?
Exactly. Missed by quite a bit. And remember, 50.0 is that critical line between expansion and contraction.
Right on the edge.
Right on the edge. So a reading of 50.1 means the services sector, which again accounts for roughly 90% of U.S. economic output,
90%.
is practically at a standstill. This isn't a slight miss. It's a flashing light for the biggest engine of growth. It signals a significant deceleration, very close to contraction.
And that immediately raises concerns about overall GDP growth, I imagine. And the market's reaction, as you said, was immediate. Punishing across the board, though maybe with some nuances. Looking at the numbers in the report here, S&P 500, the broad benchmark, fell 30.75 points, that's 0.5%, closed at 6,299.19.
Okay.
The Dow Jones, maybe a bit more resilient, slipped 61.90 points, just 0.1% to 44,111.74.
Yeah, often holds up a bit better in these risk-off moves. Less tech-heavy, perhaps.
Right. But the NASDAQ Composite, packed with tech and growth, it really underperformed, fell 137.03 points, 0.7%, down to 20,916.55.
Yeah, that makes sense. Tech is super sensitive to those long-term growth expectations. If the outlook darkens, those future earnings look less certain.
And what's crystal clear from the report is the timing, isn't it? This pivot happened shortly after 10:00 Eastern,
Right on the dot.
directly coinciding with that ISM services release. It's almost textbook, that causal link.
Absolutely. And this ISM report, it really hammered home that shift away from the bad news is good news thing we talked about.
Yeah, it feels like that finally broke.
For a while, weak data brought relief. Okay, the Fed will cut. But now the focus is expanding. It's not just will they cut, but will the cuts be enough?
Enough to offset potentially sharply lower corporate earnings and growth.
Exactly. What if the cure isn't strong enough for the disease? That's the emerging fear.
And compounding that fear is the specter of stagflation.
Mm-hmm. That's the word being whispered. And it's a much tougher environment for stocks, for risk assets generally.
Define that for us again quickly.
Sure. Stagflation is when economic activity stagnates or even shrinks while inflation keeps rising.
Okay, worst of both worlds.
Pretty much. And this concern was really lit up by the prices paid component within that ISM report. It accelerated sharply, jumped to 69.9 from 67.5.
So businesses are paying more for inputs.
Even as their activity is slowing down, that's your classic stagflation signal. It's really tough for companies. How do you pass on costs if demand is weak?
And tough for investors too, presumably. Changes the whole playbook.
Big time. Might favor real assets, companies with serious pricing power. Definitely makes you wary of cyclical businesses.
It's just been an absolute whipsaw lately, hasn't it? Tuesday's downturn followed the best day since May on Monday.
Which followed the worst day since May on Friday.
Exactly. This kind of intense volatility back and forth, it just underscores this heightened state of flux. Extreme headline sensitivity.
Feels like the market's on a hair trigger, reacting violently to every single data point or policy hint.
Like trying to steer a ship when the wind keeps changing direction every 5 minutes.
Yeah, very difficult to plan.
All right, let's zoom in a bit from the macro to the micro, because Tuesday's session really did highlight this stark divergence in corporate fortunes.
Mm-hmm.
It felt like individual stocks were moving based on whether they were plugged into, AI growth or caught in those cyclical headwinds we just talked about.
It's really a tale of two economies playing out in real time. Fascinating, but challenging.
So let's talk about the winners first.
Yeah.
The AI haven, as the report calls them.
Right. These companies almost defiantly shrugged off the broader weakness. Take Palantir, PLTR.
Big day for them.
Huge. Shares surged 7.8%, hit an all-time high. And the why is pretty clear from the report. Stronger than expected Q2 profits, and they significantly raised their full-year revenue forecast.
Wow, raising guidance in this environment.
Exactly. Revenue topped $1 billion for the first time, driven by, get this, a 93% year-over-year increase in their U.S. commercial business.
93%.
Yeah. And their CEO, Alex Karp, specifically pointed to the astonishing impact of AI leverage. It really shows that powerful secular trend in AI is, well, at least for now, overriding the cyclical concerns for these specific players.
Businesses are still investing heavily there, regardless of the broader slowdown.
Seems like it. The demand is just that strong.
And Palantir wasn't the only one in that AI haven, right?
No, not at all. Axon Enterprise ticker AXON, they leaped an impressive 16.4%.
16%. What drove that?
Significant profit beat, and they also raised their full-year revenue forecast. They cited growth in their AI-driven offerings like transcription services for law enforcement.
Another AI boost.
Yep, reinforces that theme. AI is a very strong pocket of growth in an otherwise cautious market.
Any others stand out?
Well, you had DuPont, DD rose nearly 4%. They beat earnings and revenue, raised guidance, and interestingly, they lowered their expected hit from tariffs.
Oh, how might?
Down to $20 million from a previous estimate of $60 million. Suggests they found ways to mitigate that, maybe shifted supply chains or negotiated differently. Shows good management.
Definitely.
And Pfizer, PFE, climbed about 5%. They hiked their full-year profit guidance, citing cost-cutting and strong underlying performance, so resilience there through good execution.
Okay, so a few bright spots, mostly tied to AI or solid management navigating the headwinds.
Right.
Now, let's contrast that with the top losers.
Right.
The casualties, you could say, of this economic fear and policy uncertainty.
Yeah, this is the other side of that coin. Companies whose fortunes are really tied to the corporate and consumer spending that the ISM report showed grinding to a halt.
And the biggest loser on the S&P 500 was?
Gartner Inc., ticker IT, plunged a staggering 27.6%.
Wow, over a quarter of its value in one day.
To a 3-year low, biggest one-day sell-off in over 25 years for them.
What was the specific catalyst? That's brutal.
It wasn't subtle, it was their CEO's commentary. He said confidence among U.S. chief executives has fallen to recessionary levels.
Recessionary levels.
Yeah, and he noted companies are aggressively cutting costs because of tariffs and economic uncertainty. Purchase decisions are being escalated right to the C-suite.
Which directly hits Gartner's consulting business.
Exactly. It's a powerful direct link. Macro fear translating immediately into reduced corporate spending.
Paints a grim picture for that real economy you mentioned.
It really does. And you also had Vertex Pharmaceuticals, VRTX, plummeted 17%.
What happened there?
That was company specific. They announced they were halting development of a pain treatment, VX993, after disappointing trial results.
Ah, okay. Clinical trial setback. Still adds to the negative mood, though.
Absolutely, especially on a fragile day. Then consider Edgewell Personal Care, EPC.
Chick, Banana Boat.
Yeah.
Those guys.
Right. They fell 18.8%, weaker than expected profit and revenue. And their CEO explicitly cited a weak sales season for sun care and, crucially, the negative drag of tariffs on profits.
Another direct hit from tariffs, then. Undeniable link.
Yep, right there in the consumer goods space. And even Yum, brands KFC, Taco Bell ticker UM, fell 5.1%.
Not as bad as the others, but still down.
Right. Slightly missed analyst expectations.
Yeah.
Points to maybe some softness in consumer spending, that everyday spending.
Okay, so synthesizing all this.
Yeah.
It really does feel like this incredible widening chasm, doesn't it, between this AI economy and the real economy.
That's exactly it. It's becoming the defining feature of this market, I think.
How should investors even approach this? It feels like two different worlds.
It's the crucial question, isn't it? The real economy. That's your traditional services, manufacturing, consumer businesses. They're struggling under the weight of tariffs, uncertainty, like Gartner, right? Their CEO is literally saying corporate confidence is recessionary because of tariffs and the economy.
The weak ISM data hits them directly.
Directly translates into real-world pain. Traditional indicators matter a lot there. But then you have the AI economy,
Palantir.
Axon, right at the heart of the build-out. Reporting explosive growth, raising guidance, they seem, for now, almost immune to the macro headwinds. The demand feels decoupled.
So it's more than just growth versus value.
I think so. It feels deeper than a simple rotation. It signals the emergence of these two parallel economic narratives, two tracks.
Wow.
One tied to the traditional business cycle, vulnerable to trade, rates, confidence. The other driven by this massive tech transformation, commanding huge investment, generating its own momentum.
So investors really need a kind of dual lens approach now.
I think that's right. You can't just look at the S&P 500 and assume everything's fine or everything's bad. You need to analyze companies based on their exposure to these very different trends. Granular is key.
It certainly explains why market breadth can feel so poor sometimes, even if the indices are up. Pockets of strength masking broader weakness.
Precisely.
Okay, let's broaden out again to sectoral performance. Because that distinct risk-off feeling we saw across most sectors on Tuesday, it really maps out investor anxieties pretty clearly.
Yeah, the market internals definitely showed a preference for safety, a retreat from the areas most exposed to a slowdown.
So the laggards. Infotech took a hit, ironically, after leading Monday's rally.
Yeah, significant pressure there. Even the mega caps that usually drive things, NVIDIA, Broadcom, Microsoft, Meta, all down more than 1%.
Sharp reversal.
It really highlights tech's sensitivity to those long-term growth expectations, which just got dampened by that ISM data.
Yeah.
If the economy's slowing, future tech revenues look less certain.
And consumer discretionary was also among the worst performers, right? Tied into those recession fears.
Exactly, hit hard. Gartner's plunge is a big part of that. Consulting is a key corporate discretionary spend. Plus, Edgewell, Yum brands. It all points to pullbacks in both corporate and consumer spending.
The first things to get cut when belts tighten.
Often, yes. And healthcare was dragged down, too, though mainly by individual stock losses, like that Vertex plunge we mentioned.
Okay, so tech, consumer discretionary, some healthcare feeling the pain. Where did investors find relative safety or take a more defensive posture?
Well, no sector posted big absolute gains. It was a down day overall. But defensive sectors like utilities and consumer staples would have outperformed on a relative basis.
The standard playbook in uncertain times.
Right. Investors gravitate towards stable cash flows, inelastic demand, electricity, water, toothpaste, basic food, things people need regardless. Perceived safe harbors.
Makes sense. What about financials? That seems complicated.
It is complicated. Mixed bag, likely. On one hand, slowing growth is bad for loan demand and credit quality, bad for banks' core business.
But falling treasury yields could help their funding costs.
Potentially, yes. But there's this dynamic called bear flattening of the yield curve that often hurts them.
Explain bear flattening again.
Sure. Imagine the yield curve plots interest rates for different loan lengths. In bear flattening, short-term rates fall, but long-term rates fall even faster.
So the curve gets flatter.
Right. And that compresses the gap between what banks pay for short-term deposits and what they earn on long-term loans, their net interest margin, a key profit driver. So it's often a challenging setup for banks, even with falling rates overall.
Okay, complex picture there. And all of this brings us back to that broader macro geopolitical nexus. The report suggests this intersection really dictated the market's path on August 5th.
Overwhelmingly so. It's this mix of deteriorating U.S. data, shifting Fed expectations, and this incredibly complex global trade picture. They're all feeding into each other.
Creating this backdrop of profound uncertainty.
And what's striking is how deeply intertwined they are. Let's just quickly revisit that ISM Services report again, the internals.
Okay.
Beyond the headline, 50.1 near stall, the employment index fell into contraction at 46.4.
That confirms the weak jobs report from last week.
Exactly. Suggests broader labor market weakening, maybe future job losses, and business activity and new orders also slowed. Less activity, fewer new projects, slowing demand.
But the tricky part was the prices paid component.
Right, accelerating sharply to 69.9 from 67.5, rising inflation pressure even as activity slows. That textbook stagflation signal we discussed makes the Fed's job incredibly difficult.
Stimulate growth without fueling more inflation.
The classic dilemma. And connecting it directly to policy, the report included anecdotal comments from survey respondents explicitly blaming tariffs for rising costs, delayed planning, pervasive uncertainty.
Across different industries.
Yeah, healthcare, agriculture, construction. It amplifies the dismal picture from that August 1st jobs report. Only 73,000 jobs added in July, plus those massive downward revisions for the prior 2 months.
It's just a really weak picture overall.
Very weak.
And all of this flows directly into the Federal Reserve's dilemma.
The market reaction was instant, right? Rate cut expectations soared.
Swift and decisive. The probability of a 25 basis point cut at the September FOMC meeting jumped to over 90%.
90%. Huge shift.
Yeah. Investors are now pricing in 50 to 60 basis points of total cuts by year-end, double the expectation from just a week before.
And this comes right after the Fed held rates steady at the end of July.
Right. They held at 4.25% to 4.50%. But remember, that meeting had a rare two-member dissent in favor of a rate cut.
Signaling a growing divide within the committee itself.
Exactly. Suggests the Fed is truly at a crossroads, caught between promoting jobs and fighting inflation. A very tough spot.
And this whole situation is further complicated by, well, an entirely new layer of risk.
Yeah.
The politicization of economic data.
Yeah. That's a significant development. President Trump firing the Bureau of Labor Statistics chief after that weak jobs report, it's raised serious concern.
About the future credibility of official government stats.
Exactly. When analysts and investors start questioning the reliability of the very numbers they depend on, it can have major long-term consequences.
Like for markets that rely on that data.
Potentially, yeah. Think about TPS Treasury inflation-protected securities. They're built on reliable consumer price index data. If that CPI data is seen as potentially manipulated, the integrity of those instruments is compromised. It erodes trust.
How can you assess an economy if you can't trust the basic data? Foundational challenge.
It really is.
And that theme of uncertainty weaves through everything, including global trade and policy fault lines, still a primary source of anxiety and volatility.
Still front and center, a major flashpoint that popped up Tuesday was escalating trade tension with India.
Right. What's happening there?
The Trump administration is threatening substantial tariff hikes on Indian goods. It's retaliation for India continuing to import Russian oil, which the U.S. sees as undermining sanctions.
And India's response.
They called the threat unjustified and unreasonable, pointing out that the U.S. and EU are still trading with Russia too. But despite the heated words, India confirmed they will participate in the next round of trade talks, August 25th to 29th.
Okay, so threats, but the door for talks is still open.
Suggests a willingness to de-escalate, at least diplomatically. Something to watch.
What about the seemingly endless U.S.-China negotiations? Still a source of market angst.
Always simmering. High-level talks continued in Stockholm. They're trying to break a logjam before the August 12th tariff truce deadline.
Any signs of progress?
Officials sound cautiously optimistic, but the big challenges remain. U.S. wants market access, IP protection. China reportedly sees current demands as a one-sided deal.
So a fragile truce holds, but a real resolution feels distant.
That's the sense. Keeps that cloud of uncertainty hanging over supply chains.
Was there any good news on the trade front?
Actually, yes, a rare bit, a de-escalation with the EU.
Whoa.
The EU announced a 6-month suspension of planned retaliatory tariffs on U.S. goods following a deal reached in late July.
Okay, some relief on the transatlantic front then. Shows breakthroughs are still possible.
Exactly. While tensions are high elsewhere, diplomacy can still work sometimes.
And beyond these specific trade spats, there's the broader geopolitical risk landscape constantly humming in the background.
Absolutely. Several active conflicts add to the risk. We saw the U.S. recently get more directly involved in the Israel-Iran conflict, bombing Iranian nuclear facilities.
Market reaction seemed muted initially.
It was due to a limited Iranian response so far, but the potential for a wider conflict disrupting, 25% of the world's oil supply from that region, that remains a huge tail risk.
Low probability, massive impact if it happens.
Precisely. And meanwhile, the Russia-Ukraine war is now in its 4th year. It's not just regional, it's a persistent source of global instability impacting energy, food, and driving U.S. policy against countries like India trading with Russia.
These fault lines create a constant undercurrent of uncertainty.
They really do. Influences commodities, sentiment, everything.
Okay, let's widen the lens now to international markets. Because on Tuesday, they had a really bifurcated response to the U.S. news, didn't they?
Very much so. Performance really depended on whether investors focused on potential Fed easing or the direct threat of U.S. tariffs, like different regions tuned into different channels.
How did Europe react? They rallied strongly on Monday, right?
They did. STOXX XXX 50 up 1.5%, DAX up 1.42%, FTSE up 0.66%. Recovering from the prior week's tariff slump, driven mostly by that same rate cut optimism that initially boosted the U.S.
Banks, insurers rebounding.
Yeah, helped by the bond market strength. But that optimism is fragile. Remember, European indices fell sharply just last Friday on the initial U.S. jobs data and tariff news. Shows extreme sensitivity to the U.S. economy's health.
Any sign of weakness here ripples across the Atlantic quickly.
Very quickly. And interestingly, the Swiss market actually underperformed its European peers.
Why was that?
Specific U.S. tariff threats aimed at Switzerland highlights the targeted nature of these trade issues even within Europe. Specific vulnerabilities exist.
Got it. And that split reaction rate hopes versus tariff fears was even more pronounced in Asia.
Absolutely starkly divided. On one side, markets rallying strongly on rate hopes. South Korea's KOSPI up 1.59%. Taiwan's TIX hit a 5-month high. China's CSI 300 also higher.
Following Wall Street's Monday lead.
Exactly. Focusing squarely on the good news aspect. For these export-heavy economies, a dovish Fed means global liquidity, potentially a weaker dollar making their exports cheaper. It's about capital flows.
But in stark contrast.
India. Benchmark indices closed in the red, BSE Sensex down 0.38%, Nifty 50 down 0.30%.
Directly because of
President Trump's explicit threats of higher tariffs over Russian oil. Investor sentiment there was completely dominated by that specific direct trade risk.
overriding any broader optimism about global liquidity. Wow.
It's a critical divergence. Shows how targeted policy risks can trump the general macro narrative.
What about Japan in all this?
Nikkei 225 ended higher, tracking Wall Street's lead too. But Japan faces its own pressures. The Bank of Japan is holding rates steady at 0.50%, unlike others contemplating cuts.
Different policy dynamic.
Right. Plus, the strengthening yen, a typical safe haven reaction when U.S. rates fall, acts as a persistent headwind for Japan's crucial export sector. Stronger yen makes their goods pricier abroad.
So a combination of domestic policy and global currency moves capping their market.
Exactly. A unique set of pressures.
Okay, so looking ahead, anticipating tomorrow's market, Wednesday, August 6th, it sounds like markets will likely stay on edge, focus shifting more to company specifics and policy noise.
Yeah, likely remain on edge is a good way to put it. With a relatively light economic calendar for Wednesday, any unexpected headlines or earnings surprises will likely have an outsized impact.
What is on the calendar that listeners should note?
The main scheduled U.S. releases are the weekly MBA mortgage applications, gives a sense of housing activity, and the EIA petroleum status report.
Oil inventories. People will watch that for signs of demand destruction.
Exactly. Would corroborate that broader slowdown narrative from the ISM report. Significant drops in oil demand can signal weakening industrial or consumer activity.
Any Fed speaker scheduled. Always important to listen for clues.
Yes, San Francisco Fed President Mary Daly is speaking. Her comments will be scrutinized very closely.
Why her specifically?
Well, she's previously speculated that more than 2 rate cuts might be needed this year, which is a more dovish stance. So people will listen for any reaction to this latest week data, see if she reinforces that view or adjusts it. Her words carry weight right now.
Definitely. And beyond the macro, we've got a heavy slate of key earnings reports coming out Wednesday. Real-time reads on different sectors.
Absolutely vital right now. These aren't just numbers, they're direct insights into business health in this sort of dual economy.
Who should we be watching?
In consumer and media, you've got Disney and McDonald's. For Disney, it's streaming subs and TARC's performance key indicator of discretionary spending. For McDonald's, global comp sales, traffic trends tells you about the everyday consumer.
Okay. You mentioned the gig economy barometers.
Right. Uber, Shopify, DoorDash, Airbnb. Very sensitive to consumer behavior. For Uber, bookings and profitability guidance. Shopify, merchandise volume, merchant growth tells you about small, medium e-commerce.
DoorDash. Airbnb.
DoorDash, total orders, outlook on spending habits, insight into discretionary food delivery. Airbnb, nights booked, average daily rates paints a picture of travel and leisure spending. All crucial windows into different consumer segments.
Any others?
Healthcare, Novo Nordisk is reporting sales growth for their big obesity and diabetes drugs will be a major focus given how significant those markets are becoming.
Okay, quite a list. So, wrapping up, what's the strategic outlook for tomorrow? What should listeners keep front of mind?
Well, the market will likely open cautiously, still weighing those dueling narratives, slowing growth versus impending Fed cuts.
Which story wins out?
That's the key question. Does the negative ISM story continue to dominate, or can the bullish Fed put idea reassert control? The belief the Fed will save the day.
And earnings calls will be more important than headlines.
I think so. Listen closely to management commentary. What are they really seeing in terms of demand? What's the quantifiable tariff impact? What's their actual outlook for the second half?
Widespread downward revisions could be bad news.
Could easily trigger another leg down, yeah?
Yeah.
Amplify the anxiety. Technically, keep an eye on the S&P 500 around 6,300. That was key support Tuesday. A decisive break below could open the door to retesting last week's lows near 6,216.
So, a fragile market, very reactive, increasingly discerning.
That sums it up well.
Well, that was a truly insightful deep dive into a profoundly complex day. August 5th, clearly driven by this fascinating interplay of surprising data, policy shifts, geopolitics, and this stark divergence between the AI economy and the real economy.
Definitely a lot to unpack.
It demands a really nuanced approach to understanding what's happening globally right now.
It certainly does. And maybe a final thought for you, the listener. Considering these unprecedented challenges like the politicization of data, these targeted trade disputes, how might you continue to analyze and adapt your own understanding of these interconnected forces, not just for tomorrow's market, but for the longer term? What key questions does this deep dive raise for your own critical thinking about how you process global information, especially when the data itself might be questioned? How do you position yourself for deeper understanding in this kind of environment?